All right, what's going on, everyone? It's been a while. I haven't done a live session in a minute. I promise all is well, but I'm sure you've been enjoying all the videos we've been putting up. But today I have a special guest here, and we're going to talk about the good old Uncle Sam. Uh, this is, I think there's only two things that's guaranteed in life, and I think I've heard there's only two things. I think it's taxes and death. Am I correct?
I've heard that, yes.
All right. So, and it's a lot of money that's moving when it comes to real estate, and because it's a highly regulated industry, just like I'm not sure which one is more regulated. I don't want to speak like an ignorant person. I don't know if it's the stock market, if it's the Wall Street. I don't know if it's real estate, but we know that the government agencies are interested in these industries because it's a lot of money that move hands, and ultimately, you want to make sure you're staying out of jail. You want to make sure that you don't have bills hunting you down. As 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 exciting as it is to have a business in real estate, that's the one aspect that's not exciting. I remember the first time I had to pay taxes. This is as far back as 2006. Um, it wasn't like that wasn't what I bargained for when that time came. you know, I just thought we're gonna make money. We're excited. We're gonna rent out a bunch of properties, flip a bunch of properties, and then the time came, and then my mentor was telling me like, "You're gonna file taxes." I was like, I guess, because up to that point in time, I think I had worked a job. At that time, I used to work for FedEx, and it was basically they take as much money as they want. I never looked at that part of my paycheck stub, and they gave me a return every year. But this time around, I had to pay money back, and I had to learn some interesting things. And the funny thing about this industry is that you have to stay updated because things change from time to time. So today I decided that I'm going to have an expert on the line here with. We're talking about real estate investment, but precisely we're talking about the idea that um, you do have to monitor how much money you pay back in taxes. The goal, obviously, ultimately, is to minimize how much taxes we pay back, but we want to do that all legally. So, without any further ado, I have Mr. Joseph Viry here with us from USA, USA Incorporated, correct?
U.S. tax advisors,
USA Tax Advisors Incorporated, all right? Incorporated,
Incorporated,
right?
correct.
Awesome. So, and he's gonna share his wealth of knowledge with us when it comes to taxes. But first of all, can you tell us a little bit about yourself personally, so we can have some context who we're talking to, and then I have a few questions for you.
Sure, that's great. And thanks for inviting me. To give you a brief background of myself and U.S. tax advisors group, uh, I started my professional life as an entrepreneur, and I owned a business, totally different type of business. It was in the travel business uh, until the year 2000. And then from 2000 to 2007, I began working with members of the California Association of Realtors, CAR, and I was helping them. I was a licensed I'm sorry, not tax, I was a licensed investment counselor. And I was working with people who own real estate, and I worked with the members of CAR and helping them with investment strategies. And then something happened in 2007, and that's when I don't know if you want to call it correction, crash, depression started.
I
And
know.
so the California Association of Realtors dropped way down in less than half of the membership prior to the crash. And at that time, I had this guy he kept telling me, come on, I got to tell you about the strategy. I got to tell you about this tax strategy. And finally, after him bugging me for a couple of years. I said, okay, let's go to lunch and let's sit down and talk about this tax strategy. He explained the concept of cost segregation. And I had clients who own real estate who pay taxes. So I have a few people I could give him to help him with accelerating their tax deductions by owning real estate. And when the market fell off the cliff, the owner of that company came to me and said, I think you'd be great at this. So he basically had me with him. And I started in 2007. And then throughout time, I ended up about 5 years ago starting my own company, which is U.S. Tax Advisors Group Incorporated. Now, this is not, I wanted the name applies because what we are is we're an engineering-based company who provides engineering-based studies only. So we are not tax advisors or consultants. So what I'm telling you are the concepts that I work with every day. But again, I'm not a tax advisor. So if somebody wants me to file a tax return, that type of tax planning, I can't help. What we do is relatively simple. We do primarily two types of studies. And one is the cost segregation technique, where we accelerate the depreciation expense on a building. And then number two, we also are involved in the energy tax credits. So bottom line is the government says to a building owner, if you improve the energy efficiency of a building, there are tax credits out there that will give you to reduce your income taxes. That's the carrot they're waving. You buy new air conditioners, new windows, seals, meaning doors, any type of sealing to keep the cold out and keep the cool air in during the summer. If you do a couple of these techniques and you can improve the efficiency of the energy in your building, then you can get a tax credit. So we do both of those, require an engineer. They're not meant for an accountant or for the property owner to do this on their own because they require the expertise of an engineer.
Awesome. All right, you can hear me clearly, correct?
I can.
All right, good. Wow. So that's an interesting insight there. So you're not necessarily you don't do tax returns. You're not an accountant. This is completely something different. You also mentioned accelerating depreciation of real properties, right? Now, can you elaborate a little bit more on why depreciation is actually important in real estate investing?
I'm going to do it with the real estate for dummies in mind.
Yes, from your understanding, which is not the tax advisor craziness. We don't know all the numbers, but because you have to understand that before we can even apply to a certain level, right?
Yes.
Yeah.
And I'll make it very simple. Here's my definition of what's going on. Basically, the IRS is recognizing that when you buy a building, that over time you're using it up, quote unquote. Meaning, let's do the easy one, carpet. You have carpet in a rental. That carpet is not going to last 100 years. Yeah. That carpet won't last 50, it won't last 20, it won't last 10. You'd probably be lucky if it lasted 5 years. So the IRS realizes, and they say, look, you're using up the building over time. What accountants normally do, and anybody can do this, is for the two types of buildings, one is residential property and the other one is commercial property. All they need to do, meaning the accountant or the property owner needs to do for residential, like an apartment, a multifamily, or a single family home, is divide by 27 and a half years.
Right.
So you deduct the land because land is not a depreciable asset. It has nothing to do with depreciate. It's only the building. So that's the problem. Number one is everyone needs to understand that you have to account for the land allocation. We, U.S. tax advisors groups, we're not a tax or land appraisers. So we leave that up to the client. You have to tell us, okay, how much you allocating your land. So let's say you buy a property for $120,000. and you allocate $20,000 for land, which I honestly do not care what you allocate for land. I want you to get the most bang for your buck, so I want your building to have as much value as possible. So now you have $100,000 for the building. To do a straight line calculation, anybody can do this. Divide 100,000 by 27 and a half years.
Right.
Done. That's it. So it comes out to like 3,000. It's like
Something like
3,600 a year.
Right.
Whatever that is. And you're going to get that little itty bitty deduction, $3,000 deduction over the next 27 and a half years until the depreciation benefits are gone.
It's exhausted.
Then it goes away completely.
Right. Right.
And what we do is what we're looking at is we're saying, no, that's not the correct way to depreciate a building. I mentioned that carpet. That carpet's not going to last 27 and a half years.
Right.
And the IRS recognizes there's all types, hundreds and hundreds and hundreds of classifications where they recognize this and they say, no, it's a shorter life asset. The only problem for the accountant or for the owner of the building is to determine IRS regulations and rules in court cases, what can be put in shorter lives and what can't. That's the job that we do. So
and that's also not their job, because they're not going to do that part for you. So with that being said, can you break down cost segregation for us?
Yeah, well, that's what cost segregation is. We break out the personal property from the real property.
Okay, that's what it is. The fact that you separated from the land, and now you can now work with that number.
Right, and the building has a number of different characteristics, but I'll make it simple, less complicated for this discussion. So basically, everything in the inside of the house is 5-year personal property, almost everything. Everything outside, site improvements, is another acceleration. It's 15-year property.
Right.
So basically what we're doing as engineers is we're determining, okay, how much 15-year property. So now in the example, I had $100,000 for the building basis. So we're going to decide how much is 15-year, how much is 5-year property. And when you do the math, if you combine 5 and 15-year property, you're always going to have 27-and-a-half-year property, the real property. That's the basic shell of the building, the roof, the walls, the foundation. That's not going to go away.
Right.
I can't accelerate that. But when you combine the 5 and the 15, and then now you add it to the 27-and-a-half-year property, that gives you the acceleration. By taking the shorter lives, combining it with the longer lives, now you get to take that up front. And the beauty of the new tax law a couple of years ago, the Tax Jobs Act that Trump passed a couple of years ago, is that there's a concept called the 100% bonus. 100% bonus. And basically everything I find in 5 or 15 year, now currently for the next couple of years, up until tax year 2022, the owner of the building can get 100% bonus, meaning everything I find, they can take it all up front immediately. So going back to my example, if you have a building worth $100,000 and I find 25% of that building, or $25,000, basically in tax year 2020, if you're on extension. Yesterday was those not on extension, they had to file their taxes.
Right.
Those on extension have until September 15th or October 15th. And if you accelerate your depreciation, what I'm going to give you is a $25,000 tax write-off in the year 2020. So it's about 25% of the building basis is what we find we can accelerate.
Okay, I have 2 questions for you. So what? First of all, in a typical situation, right? What usually has the biggest value when it comes to the personal properties that you would segregate for the purpose of this strategy? What usually will be has the biggest value, like items?
What it's going to be is, this is another example I learned 15 years ago. If you have a giant and the giant rips the house out and then he shakes it, basically everything that falls out, the carpets, the window coverings, the cabinets, the cabinet tops, and to make it even a little bit more easy, what we're looking for in a very, very rough general term, is anything that can be removed and taken away by that building owner. Now, that's a silly example because obviously the building owner is not going to chisel tile from the walls
Right.
or
Right.
from the floor, but technically the IRS agrees that ceramic tile is personal property. Now,
Oh wow.
what happened? It doesn't make sense, but how it happened is somebody took that issue to court, and the
Mm-hmm.
judge ruled that the ceramic tile is personal property.
Wow.
It doesn't have to make sense. The IRS does not have to make sense.
Even though it's almost falling in the line of a fixture, uh, again, what are the limitations here? What about fixtures? What about fixtures on the wall and stuff like that? Can those things be personal property? Can the chandelier be a personal property?
Well, actually, chandelier is.
Oh wow.
However, if you had a room and you had two fluorescent lights and you had a chandelier, the two fluorescent lights are 27.5-year personal property. They cannot be accelerated. The chandelier is accent lighting. So
Hmm.
what we have to do as engineers is we have to look at the building and say, okay, what's the primary source of light? What's the accent or the decoration? And we break out the decoration and we can put that in the 5-year bucket.
Interesting. Interesting.
So
All
there's a
right.
lot of nuances, and like molding around the carpet, the wood molding, or whatever, any kind of molding, that's personal property. The window coverings, that's personal property. If you had, like every place has countertops, every place has cabinets, wood
Right.
cabinets. That's all personal property.
Wow. That's interesting because I feel like most people are probably neglecting that aspect, and all they're doing is just calling the whole thing uh, the real asset,
It's easy.
right? And a lot of people they don't think that they just like okay anything because again it's a little bit of extra work which is why I think where your services will be valuable because people don't have time to be try to assess every little thing that can shake out of a house if a giant picks it up, right? Right? Most people probably don't have that time to be figuring that out. Most investors are busy trying to get the next deal, right? So now, at what point is this even worth it at all? I don't know what your services cost. At what point is it worth it? Is it not worth it? What level of property would you advise needs to take advantage of cost segregation? A one single family landlord, I don't know if that's a landlord, but right, but or a 32 units. At what point do you think?
Okay, I'll make it really simple.
Yeah.
So here's what happened in my life and what happened in the industry is we all grew up back in the day in 2007 with what we call the full detailed engineering study. What the full detailed engineering study means and requires is that somebody has to visit the property in person and measure everything we talked about.
Hmm.
So I do that all the time. I do that like between now and September 15th. I'm gone most of the time because I'm looking at properties all over the United States. And
Hmm.
I'm counting light bulbs. I'm counting flooring, like how much square footage. I'm counting all of the personal property and identifying it. Then that information goes back to the engineer, and the engineers do all of the heavy lifting. They put it all together in the report. And so basically, that's the old fashioned way. The old fashioned way, going back again 15 years ago,
Hmm.
I couldn't apply that to a single family home. I couldn't apply that to a small multifamily. The
Hmm.
buildings had to have a value of $1 million about minimum. What we did 5 years ago is we developed another strategy that's approved by the IRS, and we call it the modeling strategy. For modeling, I'm not going to the building. We're doing everything using a statistical analysis that we've developed. So
Okay.
what we're doing is we're taking the information on the building. I'll just make it up. 1,500 square foot house, 3 bedroom, 2 bath, a 6,000 square foot lot.
Right.
We
Now,
look at
to
it.
be clear,
Yeah.
you don't make it up for your client. You're making it up for this example, correct? To
Yes.
be clear.
Yes.
Okay.
No,
All
we don't
right.
make it
Good.
up for the clients.
Okay.
No.
All
No.
right. Good.
No.
Good. Yeah.
And so we put all the numbers into a
To
statistical
a model.
analysis. Yeah, a model, and we come out with the numbers. The advantage the client and the accountant have is that you have somebody to depend on to back up the numbers. We have never been challenged by the IRS. They've never questioned. Well, I take it back. They've questioned our work, but we've never lost. In other words, we answer their questions. We show them how our model works, and they say, "Okay, got it. Bye." And
Wow.
so that's what you're getting when you have me do it, because we come up with a defensible model that if you ever get questioned by the IRS, we will go to bat for you at no extra charge. So to answer your question for the modeling technique,
Mm-hmm.
I have done those for buildings and made the math work for buildings with a building basis of $30,000. Now that was years ago. So now it's hard to find a building. It's hard
Right,
to find a
right.
building that you can buy for 50 grand. That's pretty tough. Or 40
Yeah,
grand.
yeah.
But you still can.
Unless you're in the middle of nowhere in Texas. Yeah.
Well, you might.
It depends on
So,
what we're talking about, right?
but here's the deal. So in other words, to answer your question, we
Mm-hmm.
do it for single family. We do it for any kind of building. Commercial buildings, we'll run the analysis for it. And so I would say that really, truly, any building that you buy, you would want to call me. If you're going to be paying income taxes, you'd want to call me. And what we do is we run an estimate at no charge. And we tell you,
Okay.
okay, this is what it's going to
Awesome.
cost. This is the benefit. Okay, Mr. Taxpayer, Mr. Accountant, you decide. Do you want to do it or not? So what I like to do is if I can't get the value of the losses 10 times more than my fee.
Mm-hmm.
So if I'm charging $450, I would expect the taxpayer to save minimum $4,500 in income taxes.
In taxes.
If they can't do that, then I would tell them I wouldn't do it.
Then it's not worth it.
No, I would say don't go save your $450. Don't do it. But it's up to the taxpayer. If the taxpayer says, "Wait a minute, I'm only saving $3,000 and you're charging me $450," well, hell, I'll beat the IRS for $3,000. Well, that's their decision to run with the $3,000. I would still tell them I wouldn't do it if I were you, but if they want to pay me to do it, I'll do it. So it's not a bright line.
Mm-hmm.
So it's up to the individual, and I give them the information at no cost. They should take it to their accountant and say, "Hey, this is what Joe's going to do. Should I do it or not?"
And it makes sense to me because one of the biggest, you mentioned 2007 earlier. I was in the middle of that 2008 crash. As a matter of fact, my first business got wiped out with that. And one of the mistakes, one of the mistakes that I made, which is still an ongoing thing because again, we're learning every day, right? Is not paying attention to details and thinking that, yeah, that's, you're getting to this place where you're complacent about business and you're just saying things like, that's negligible. You say that's negligible. Well, yeah, how much money can I pay if I depreciate my carpet the right way? If I depreciate that lighting, that fixture the right way, or the cabinets the right way, right? And not make the cabinet the real property, because it's not, right? You just neglect a lot of little quote unquote little details, but such an important detail that really adds up and compounds out in a big way over time. So it makes sense to me that because when I first saw cost segregation, I'm like, I had that epiphany. I was like, this is going to be an interesting conversation because most people don't do it.
Well, you know what?
Was
You know
that?
what?
Yeah.
They don't know about it.
They don't know about it. They don't know
No,
about it.
90% of accountants out there, CPAs, they don't get it. It's easy for them to take a calculator and divide by 27 and a half.
Right.
Their grandchildren can do that. So that's what they like to do. They don't want to hire a Joe because, number one, they know nothing about depreciation. So
Yeah.
I'm not blaming them. I'm just telling the taxpayers, here's the caveat. If you own real estate and your accountant says you need to write a check to the IRS, you definitely want to get someone like me involved, because there really is, real estate has so many tax advantages. This is just one,
Yeah.
but it's a big one. And you take advantage of, you call me and say, "Joe, here's what I own. Do you think I should do it? And I'll be honest with you. I'll either say yes or no. And to cover this, to make sure that everybody understands, there's very few circumstances where I would say no, don't do it. Somebody did have a house.
Can you give us an example of that?
Okay, here's the biggest problem I run against is a concept called passive versus active.
Yes.
Do you know what that is?
It depends on what we're talking about. So passive investing, passive.
Yeah, a real estate investor. A real estate investor is either passive or active.
Oh, okay. Like a passive investor is somebody, your money is all that's working for you. You don't really get involved in the day-to-day activity of the property or the well-being of the property.
Well,
It's just your
unfortunately,
money.
since the IRS is involved, it's a little bit more complicated.
Exactly.
It's never simple with the IRS, you know.
Exactly, and that's always been my outlook, and I admit that it's because of the experience I went through in 2008 that gives me that. Because before that, some things are negligible. But for me, as far even if it's my money that's working, that's I still need to be aware of what's going on, right? And
Right.
it's almost like when people go passive income, like it's almost like there's a part of my brain that goes, there's no such thing as passive. You're always, even if you're, God forbid, dead.
Well, here's how it came about, and everybody
Yes,
can understand this. In
yes,
the 1980s, doctors, I'll pick on doctors. Sorry, it was anybody, but let's say doctors.
yes.
Doctors were out there, they were buying real estate that were lucky that the walls still stood up. And now
Mm,
there's demolished, beat up buildings. They were paying money for them because of the depreciation expense.
right,
Because as a doctor, their income was I'll make a number of $500,000 a year, and they wanted to not pay taxes on 500 grand, so they
right.
would be buying this real estate. So
Mm,
Congress and the IRS, said, look, wait a minute. Here's the deal. If you are a doctor and you have doctor's income, and you're not actively involved in your real estate, then you're a passive investor. And so they put limitations on the amount of depreciation a passive investor can take. And so obviously,
wow.
if you're a passive investor and you don't need accelerated depreciation, I would be the first to tell you there's no reason to do it. Don't do it. You'll never get hurt. But when I said 10 times the fee, if you don't need that $4,500 in expenses to offset income, then I would say don't do it.
I see. I
But
see.
let me go one step further. It's pretty rare that even a passive investor can't use what I give them. But it is very possible. It is possible that
So let me
they
let me get this straight. Sorry, let me get this straight. So a doctor is invested into a deal. There's an actual property. There's actual depreciation going now,
right,
right? But because they have another income, they cannot take advantage of this.
right.
Eh, Okay, so
They
why
can
not? The property
small.
is still being used.
No, they can't accelerate their depreciation.
They cannot
They
accelerate it.
Yeah, they can't accelerate. They can still take depreciation, but they can't take the $25,000. They can't use it.
All right,
So the
so
government
help me
limits what they
out.
can use.
Help me out a little bit. Let's assume the doctor's involved in the deal. They're not really active, but deal is rented out like any other property, right? Um, yes, accelerated, but they're still those things are still being used. So can you? I think you probably just can you still break it down a little bit more for me in a simpler way why they can't accelerate? Because acceleration is legal after all, right?
It
Can
is.
you break that down a little simpler why they can't?
Yeah, I'll make it real simple. There's a limitation to passive investors. The IRS caps it at $25,000 per year per entity.
Per year per
If
entity.
you're not passive, my benefits are unlimited. If I give, and by the way, I mentioned small investors, but I work with big investors. I do square blocks downtown San Francisco worth $500 million. So I work with a small, I work with a large. So when I gave that 500,000, a $500 million investor, I gave them $100 million in tax savings. Okay,
Okay.
so there's no cap. Why? Because they were not passive. I gave the owners of the building, who were all active investors, I gave them active losses. So basically what happens is the IRS caps passive losses. That's
I
why.
see.
That's why I'm going to give them to you. You just can't use them.
I see. Because it's attached to you, the taxpayer, not necessarily
Yes.
not necessarily the elements of the property. It's attached to you as a taxpayer. The benefit is for you. Okay. All
Now,
right.
there's a couple strategies to get around it. Number one strategy, obviously, if the building itself is throwing off a lot of income, you probably will still want to accelerate it. But you know how it is with real estate. A lot
Right.
of times, the way it works is that the owners get so many deductions that they really don't have a lot of taxable income. That's the reality. Some do, lots don't. So they don't need me.
Gotcha. Gotcha. All right. Let's address this next question here. Can cost segregation be performed on properties acquired prior to this year?
Oh, that's a great question. And there's a big misnomer and uneducation on that. We do two types of studies, both for modeling and for the full detailed engineering. We do current year and we do lookbacks. And lookbacks are just that. Any property that was acquired previous to 2020, so 2019, and I can go back about 20 years.
Okay.
So let's make the math simple. I can go back to about 2003, 4, 5 when you acquired the property. And this is another good concept for people to understand. The IRS has, for what I do, depreciation is not based on what the property is worth. Nobody cares.
Yeah, because we're going to segregate that, right?
No. We only look at what the property was paid for, that amount, not what it's worth. So if you bought a property for $10,000 and now it's worth $100 million, the IRS doesn't care. They're looking at $10,000. That's what you paid
So
for.
if you paid for a property 2003, you paid $100,000 for it. It's worth $500,000 today.
Don't care.
In the first place, why can you tell us why we needed that number? Now my investor mind is thinking, because what matters to me is what the property is worth, right? Right.
Yeah, no.
So I'm trying to get out of that right now.
Out of it. Yep.
Now the $100,000 to me is it's usually a useless number. How much I paid for it, unless I'm trying to, even honestly, if I bought the property for $100,000, right, and I'm trying to sell it for $300,000 right now, that's not really $200,000 profit for me, because a lot has happened since 2003, right?
Right.
So what do we need that number for in the first place? The 100,000. What do we need that for?
Because that's how much money came out of your pocket, and how you buy your property, the IRS doesn't care about. So if you buy a property for $100,000 and you have 90% of that financed, that's not relevant. The IRS only cares that you bought a building worth $100,000, and so that's the amount of depreciation. That's what your depreciation is going to be based on. And the reason is relatively simple, because the IRS has no idea what your property's worth. How would they know what it's worth?
Right. We don't want them to know either.
Well,
you
you
kind of don't want them to know, right?
But they do know what you paid for it. You know why? Because you have to report that to the IRS. If you buy a building for $100,000, you have to put that on a piece of paper, and you have to file that in your tax return.
Right.
So they know that you can't lie to them, like, oh no, I didn't buy. No, you bought it for $100,000, because you show it in your tax return that you bought it for $100,000.
And it makes sense that that's what you're trying to. I mean, that's the money that came out of pocket. That's what that's the only thing that tax references anyway. Okay, that makes sense. All right. Okay. All right.
But anyway,
so you can go back. You can go back to 20 years, up to 20 years.
Now, that's a floating number, because what we look at when you do what I do is I'm looking at, okay, what kind of fee am I going to charge you? How much am I going to save you? Because you can't double dip. So in other words, if you for the last 20 years, if you've been taking straight line depreciation on the building, and now I can tell you what you're going to accelerate, you have to deduct the amount of depreciation you've taken over the 20 years.
Right.
You can't do both. So you have to disregard that. So what we do is we have to look at, okay, how much am I going to charge you? How much value are you going to get out of it? And then the owner and the accountant are going to decide whether it's worth it. So I know the numbers, and I will tell you 20 years is about the maximum we can go to make the numbers work. Anything acquired previous, if you bought a building in the 1990s, there's just not a lot of meat left on the bone. So you don't need me.
It's not even worth. It's not worth the headache.
No.
Now let's assume. Let's assume we're going back 5 years. Sorry to interject.
No, that's good.
Yeah. Let's assume we're going back 5 years, right?
Right.
Does that mean the IRS could potentially owe me money if I had already paid some taxes?
Wow, you're good. Well, there's a new part of the tax code law that just came into effect in 2020 in May, called the CARES Act. And what happened in the CARES Act is the IRS said that because of COVID and all of that stuff going on, that you can go back and you can use losses for I think it's 5 years, and you can get a refund if you have expenses that you can apply to get the refund. And one of the expenses, guess what, is what I do. So even if you don't need the losses for 2020, like your accountant says, hey, you're going to pay zero, but last year you paid $50,000 in taxes, I would advise the client to look at the CARES Act and to use the losses that I'm going to give you, that $25,000, and go back and tell the IRS that you want a refund. So you can do that, and savvy investors do that, but very few people understand how it works, and that they can go back and get a refund. But I'll make it simple. If you own real estate and you've paid taxes in the past, by all means, talk to somebody who knows what they're doing, and say, if you haven't accelerated your depreciation, Joe can accelerate the depreciation. He can give you losses, and then I'd say, Mr. Accountant, go back and get me that money. I want a refund.
Right. Now, here's everyone's worst nightmare, right? Our taxpayers who have properties using this method, accelerated depreciation, are they more likely to be audited by the IRS? This is the kind of call, or let me say letter, that you never want to get, right?
No, you never want to get. The answer is, when I first started in 2007, it was a new industry. The acceleration has been around for a long, long time, but it went by different names. It was called component depreciation in the 80s. It's been around, supposedly, somebody once told me, since the 1930s. So let's put that all aside. What happened was, in 1997, a big court case came about with the Hospital Corporation of America sued the IRS and made all of these claims. Wait a minute, I've got personal property. The IRS can't make me use straight line. I should be able to deduct all these expenses. And this company, Hospital Corporation of America, HCA, owned hospitals all over the United States. And they were not nonprofit. They were for-profit hospitals. So the IRS listened to the judge listened to the IRS explanation, and basically said, you're screwing the taxpayers, IRS. Number one, I agree with Hospital Corporation of America, and you, Mr. IRS agent, you must tell them that you screwed up, and you must allow them to go back and take advantage of acceleration, and you must write a document, which is now called the cost segregation audit guidelines. You must write a paper and explain to everybody how it works and why it works. So it took the IRS a couple of years. In 2004, they published the audit technique guidelines, which gave everybody the roadmap of what the IRS needs from the engineer.
If you decide to use it.
Yeah. So anybody can go and read the document that we abide by. Everything we do, we follow to the letter. And so we're good at that. And so bottom line is, because of all of this process, IRS agents know the cost segregation is real. They don't argue. So no, if they see
we're not pulling random terminologies out of our ass to go get money from. This is just like many things that are available out there that we just don't know, right? this is one of them. And ignorance is not an excuse, but it's real, But thank you so much for
Yeah, it's
for
really,
breaking this
really,
down.
yeah, I mean, it's really important, and that's a big fear. Is that everybody thinks they're going to get audited, but the answer is no.
Okay.
It's not an audit. Now, the IRS agent might ask the taxpayer. Let's say that somebody gets audited for another reason,
Mm-hmm.
and then the auditor goes, "Oh, you did cost segregation on this building," and the taxpayer and the accountant go, "Yeah, we did," and they're going to go, "Let me see the report." Show them the report, and let's say, "Oh, I've got a question. They said there was X amount of value to the carpet. I don't know if that's right. It doesn't sound right to me." So basically, the taxpayer or the accountant would call Joe. I'll get the engineer on the phone with the IRS agent to explain to them how we came up with what we came up with, and
Mm-hmm.
then that's it. No more said.
Right.
They'll go, "Oh, okay, I get it now," and they go away. So could we have questions? We could have questions, but you're not going to get an audit
Mm-hmm.
based on my work.
Mm.
You
I know you're
understand?
going to tell us the truth about this one. Are there a lot of companies that do what you do out there in terms of these services?
No,
Or
I don't always tell the truth about this. Yes, you know what? It's still a very small number of companies out there. But yes, I have competition. Number one. Number two, the reason why we're good is because of the experience. My partner, myself, and my engineer have
Mm-hmm.
been doing. My engineer has been doing some form of cost segregation for 30 years. So we're good. We know what we're doing. That's number one. Number two is there's very few companies that do the modeling approach.
Okay.
There's just not many out there. You could Google it and see if you can find it, but I only know of two off the top of my head, and they both charge more than we charge, and their studies just aren't as good. But
Right.
let's forget the good part, the bad part. Let's just say there's very few companies out there, and that's another reason why accountants don't even know about what we do because unless they
Right.
find out from
Right.
me or the client, they're not going to know.
No, no, no. Granted, it's not as popular as even the word depreciation itself. Everyone knows that a benefit to investing in real estate is depreciation, right? And the
Right.
fact that you can take advantage of that, even though we know that real estate appreciates over time. Everyone knows that part. But in terms of breaking it down, it's just too much details for an average person. And I'm so appreciated. I'm appreciative that you're here to help us give value to the people, to our audience. Now, majority of our audience is people that are in wholesaling. They're looking to flip a quick one and keep it moving. They're just looking to make money. In fact, many of them never hold on to the property. But the truth is that they have relationships with investors, right? And one of the best ways to be the best wholesaler in any marketplace is to also bring value to your investors, right? You tell them about certain things that they may not know already. A lot of the investors are also new in the game, meaning 5 years or less in the game, meaning they could be taking advantage of it, but they haven't gotten to it because a lot of them, when they get started in fix and flips or anything like that, or even fix to rent out, they usually get burnt on their first deal and then they back out for a little bit and then they come in again, or some of them disappear for life because they got burnt the wrong way.
Yep.
So but when they know that these opportunities are available like this, then they can share with their investors in their network as well too. So I am personally appreciative
Well,
of knowing
on
about
that
this.
subject, my largest, um, we're not financial partners, but partners in this is exactly what you said. They are a wholesaler, and they tell everybody that buys a property from them about what we do, and they give us a ton of business every year.
Awesome.
And most wholesalers don't even know to do this, which is frustrating. Now, I will tell you that there is another concept called depreciation recapture. And that means, to make it very simple,
Hmm.
you're going to have to pay back your depreciation expense when you sell the building. You don't do it when you exchange into a new building. You don't have to worry about depreciation recapture. It's only when you sell for cash. So it's kind of rare that it happens, but of course it can.
Hmm.
But bottom line is, with depreciation recapture, and this comes from my financial team, is that we tell people if you're not going to hold the property for at least a year and a half
Mm-hmm.
minimum, you don't want to pay Joe to do any
Right.
acceleration. Don't
Right.
buy it.
Right.
Don't do it. If you're going to hold it for a year and a half, probably look at the numbers and see. And what's going on right now in this environment is a
Mm-hmm.
lot of flippers are deciding to hold a core number of properties.
Yeah, yeah. We're advising that right now.
Yeah,
Like the whole idea of coming into the game just to flip. No, come on. You should be holding too. You should be holding
yeah,
for long term. You should be holding some. You should be partnering with people because first of all, it tells that you actually believe in the game, right? Then also there's certain knowledge that comes from holding that you just can't get from flipping. Fix and
yeah,
flip sorry, buy to fix to rent out. Have a few tenants out there. You don't have to. You could also be passively involved in it, right?
right.
But you get to know what's going on in the game as opposed to just wholesaling. So we're definitely recommending that more. So wholesalers themselves should be needing this. You
Yeah,
know,
I
yeah,
find it all the time. I get people who call me and go, "Hey, Joe, you remember me? I'm a flipper." I go, "Yeah, what's going on?" He goes, "Well, I'm going to hold 10 properties this year. I need you."
yeah,
Great. Yeah.
yeah,
Now,
yeah,
if you're in the industry, you're active.
yeah.
Meaning, if you're in the real estate industry, let's say that doctor retires from being a doctor, now he manages his portfolio of properties. Guess what? He's an active investor. He's
That's
not no
active.
longer passive.
Yeah,
And
yeah.
anybody who's a flipper, anybody who's a realtor, anybody who's in the industry, they're active and they can use all my depreciation expense across any income. That's what it means. Any
Yeah,
of their income.
yeah,
Wall Street investments, you know, businesses they buy, they can use my depreciation.
absolutely, absolutely.
So
Yeah, we're gonna be staying in touch definitely. What else would you like people to know about US TAG US Tag Incorporated.com? That's the website. Is that correct?
that's what. Now, here's what they'll do. If you go to the website, there's a link on there to get a free estimate on any of your buildings. Um,
Okay,
use that intake form, that part of the website. And the website is it's US Tax Advisors Group. There you go.
does that
So
look
it's
right?
that's it. So it's
Okay,
USTAGINC.com. Go to my website, and basically the phone numbers are there to talk to call me. The
got it,
emails are there, and then also to get the free analysis. And again, we do not charge for an analysis.
got it. And they can just complete this form,
Send it in,
and
and we'll
you
get
guys
back
will
to
take
them
it from there.
with an, yeah.
And there's contact information on there as well too. Awesome. Thank you so much, Joe.
You're very welcome.
My pleasure, and we'll definitely be in touch. Everyone, thank you so much for hanging out. If you got here late, go watch it all over again. There was tons of value bombs in this session, much more than I expected. But as always, when it comes to taxes and saving money on taxes, honestly, if you're already making money, this should not be a boring subject for you. I understand if you're getting started that it may be boring, but this is the point where you want to self-awareness. This is gonna bite you in the butt later. You need to know this stuff, right?
Yep.
So yeah, thank you so much, everyone. Well, we'll see you. The contact information is on there. USTAG Incorporated.com. And oh, by the way, we're going live in about 2 hours. Here, we're going to be running through wholesaling real estate for beginners from step by step. We're going to be spending about 45 minutes on that. It's a full-blown course, so don't miss out on that. And I will see you guys on the next one. And peace.